Hey traders, welcome to another episode of iTradez Support and Resistance. These are the foundation of technical analysis. Every professional trader uses them, whether they're scalping on the 1-minute chart or problem. Most beginners get them wrong. They draw too many lines. They mark random levels. And then they wonder why the market keeps breaking through their so-called strong zones. Today, I'm going to give you a complete breakdown. By the time you finish this, you'll know exactly how to spot them, how to draw them, how to trade them, and how to avoid traps. We'll start with line charts so you understand the core concept without distractions, and then we'll switch to candlesticks so you see how it plays out in the real market. Welcome back. What is support and resistance? Let's start simple. Support is the level where price tends to stop falling and start bouncing upward. Think of it as the market's floor. Resistance is the level where price tends to stop rising and start dropping. Why support and resistance work? These levels aren't magic. They exist because of human psychology and the way orders are placed in the market. When price hits a level where buyers were previously active, those same traders often buy again. Why? Because they remember, last time I bought here, the market went up. I'll do it again. The same goes for sellers at resistance. If a level caused price to drop before, many traders will sell when price reaches it again. It's also about big institutional players. Banks, hedge funds, and large investors don't enter all their positions at once, they scale in. If they bought heavily at a certain price, they're likely to defend that price if the market comes back. That's why these levels keep holding. They represent areas where there's an imbalance between buyers and sellers. Spotting key levels. This is where beginners make their first mistake. They mark every tiny bounce as support and every small drop as resistance. That makes their chart look like spaghetti, and it becomes impossible to trade. The secret is to look for key levels, levels that caused major market reactions. A strong level has at least 2 significant touches where price reacted clearly. The more touches without a break, the stronger the level becomes. And here's a golden rule. Levels from higher timeframes are stronger. A daily chart support is more important than a 4-hour chart support, and a 4-hour is stronger than a 1-hour. For example, if you see a daily resistance that's been tested 3 times, that's a major ceiling in the market. Traders across the world are watching it, which makes it even stronger. How to draw them correctly. This is the second big mistake I see. People draw a single thin line for support or resistance. But here's the truth. Price doesn't move like a laser beam. It moves in zones. If you treat support and resistance as exact prices, you'll keep thinking they break when they're actually holding. Here's how to do it right. First, find the area where the most candle bodies have closed. This is the core of your level. Then extend it to include the wicks above or below. That gives you a range, a zone, instead of a single number. When you do this, you'll notice that many so-called breakouts were actually just price testing the edge of the zone before reversing. Also, keep your chart clean. More than 2 or 3 major zones on your chart will just confuse you. The market is already complex. Don't make it harder by turning your chart into a coloring book. Support turns into resistance. One of the most powerful concepts in trading is role reversal. When support is broken, it often becomes resistance. When resistance is broken, it often becomes support. Why does this happen? Because of trader psychology and market positioning. Imagine price has been bouncing from a support level for weeks. Traders keep buying there, thinking it's safe. Then one day, the market smashes through it. Those buyers are now in a losing position. When price comes back up to that level, they're desperate to get out at break even, so they sell. And that selling turns the old support into a new resistance. The same works in reverse for resistance turning into support. Once you understand this, you'll start spotting powerful breakout retest setups. False breakouts and liquidity grabs. If you've ever traded a breakout only to see price immediately reverse against you, congratulations, you've been caught in a false breakout. This is one of the most common traps. Price moves just above resistance or just below support, triggering breakout traders and stop losses. Then it reverses sharply. Why does this happen? Because big players use these areas to grab liquidity. Think about it. Above resistance, there are two types of orders: breakout buy orders and stop losses from sellers. Below support, there are breakout sell orders and stop losses from buyers. By pushing price into those areas, big players fill their large positions. Once they've done that, they move price in the opposite direction. The lesson? Never trust the first breakout. Wait for confirmation. A retest and a strong candle close in your favor before committing. Using support and resistance in your trading. Now let's put this into a practical system. Step 1. Start with the higher time frame, daily or 4-hour. Mark the most obvious clean levels where price reacted strongly in the past. Step 2. Drop down to your trading time frame, maybe 1 hour or 15 minutes. Look for smaller intraday levels within the big zones. Step 3. Look for confluence. Is there something else at this level? A trend line, a moving average, a supply-demand zone, or a fair value gap? The more factors lining up, the stronger the trade idea. Step 4. Wait for price action confirmation. Look for a break of structure, a change of character, or clear rejection candles before entering. When you combine support and resistance with other tools, you move from guessing to stacking probabilities in your favor. Bonus tip: dynamic support and resistance. Not all support and resistance is horizontal. Some are dynamic, they move with price. Examples include moving averages, trend lines, and channel boundaries. In a strong trend, price often bounces off these dynamic levels repeatedly. However, remember, dynamic levels are generally weaker than major horizontal zones. They work best when combined with horizontal levels for extra confirmation. Summary: support is your floor. Resistance is your ceiling. Strong levels have multiple touches and are visible on higher time frames. Always draw zones instead of thin lines. Watch for role reversals when a level breaks. Be cautious of false breakouts and liquidity grabs, and combine these levels with other tools for higher accuracy. Mastering support and resistance is like learning the alphabet of trading. Once you understand it deeply, every other concept, from order blocks to liquidity hunts, will make more sense. That's set for today's video. If this video helped you out, tell which video you want next. TradingView tutorial or mitigation block drop. A like and subscribe to the iTradez channel. The more SMC and ICT content coming soon.